Hey everyone, and welcome to this brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. I am absolutely thrilled to have you joining us today. So, in this explainer, we're going to do something really fun. We're going to conduct a forensic walkthrough of a pretty fascinating case study. The specific observation we're tearing apart today was actually featured in the 217th edition of the Task Weekly newsletter, which is brilliantly authored by C.A. Monish C. Iyer, director at Gap Advisors over on LinkedIn. If you're the kind of person who loves digging into the actual, real-world application of accounting standards, well, you're in exactly the right place. Let's get into it. Okay. Just a quick look at our agenda for today. First, we'll welcome you to the clinic and set the ground rules. Then, we'll look at the company's accounting policy, test it against Ind AS 16, and then test it again against Ind AS 1. After that, we'll hit our final verdict, and finally wrap up with how you can elevate your own compliance. All right, diving right into Section 1, welcome to the clinic. We just need to lay some quick ground rules for the investigation. To make sure we're all completely on the same page, we're adhering to these baseline facts for our context today. The functional and presentation currency we are talking about is the Indian rupee. So naturally, foreign currency is anything that's not the Indian rupee. Our reporting period runs the standard April 1st to March 31st. And just a quick but super important disclaimer here. Please keep in mind that the views expressed in this explainer are entirely personal and they aren't binding. You should always seek the help of a qualified expert before taking or refraining from any action based on what we're discussing today. Now, the reason we really need to establish these rules is because this observation, it's not theoretical at all. It actually comes directly from the published Ind AS financial statements of a real listed company. Gap Advisors actually downloaded and independently reviewed these on a suo motu basis. And why does this matter to you? Well, think about it. If you happen to invest in a listed company's shares, having a thorough review of their financial statements for Ind AS compliance can literally make or break your decision on buying, holding, or selling those shares. It is absolutely crucial.
Moving right along to Section 2, the company's accounting policy. It's time to present the evidence.
Let's actually look at what the company wrote. What's really interesting here is the company's explicit claim regarding their property, plant, and equipment, or PPE. If you look closely at their text, they state that an item of PPE is derecognized upon disposal or when no future economic benefits are expected. Okay, but then they explicitly mention that any gain or loss arising on the disposal or retirement of an item of PPE is determined and recognized in the statement of profit and loss. I want you to keep that specific word retirement in the back of your mind. It's really the whole crux of our investigation today.
Which brings us to Section 3, Testing against Ind AS 16. Let the cross-examination begin.
So let's hold their policy up against the strict letter of the law. According to paragraphs 67 and 68 of Ind AS 16, an item of property, plant, and equipment is absolutely not derecognized simply because of retirement, and no gain or loss is recorded at that moment. But honestly, even more crucially, paragraph 55 makes it undeniably crystal clear. Depreciation does not cease when an asset becomes idle or is retired from active use, unless it's already fully depreciated.
So check out the glaring contrast here. The company completely contradicted Ind AS 16. By following their own stated policy, they didn't just prematurely stop depreciation when an asset was retired, they completely derecognized it and then recognized the loss or gain. I mean, wow, this is a fundamental, textbook misapplication of the standard.
But, the investigation doesn't stop there, because an error in one place almost always bleeds into another. So let's hit Section 4, Testing against Ind AS 1, specifically looking at the statement of profit and loss.
If we jump back to the company's policy for a second, after dealing with the retirement of the asset, they casually claim that the resulting gain or loss is recognized in the generic statement of profit and loss. Now, at first glance, that sounds totally normal, right? But let's look a little closer. Here's the catch. Paragraph 10A of Ind AS 1 strictly mandates that an entity must present profit or loss and other comprehensive income in two very distinct sections within that single statement. Because the statement is made up of more than one section, simply waving your hands and declaring that a gain or loss is recognized in the statement of profit and loss completely fails to identify which actual section is being used.
And guys, this perfectly fits the definition of obscuring information under paragraph 7 of Ind AS 1. The standard says information is obscured if the language used is vague or unclear. By failing to specify exactly which section of the statement the gain or loss hits, their vague wording essentially hides the true financial presentation and impact from primary users. They might as well have just omitted it entirely.
All right, so Section 5. Let's look at the final verdict for this compliance failure.
Based on all the evidence we just walked through, the verdict is incredibly clear. By incorrectly applying depreciation and derecognition rules the moment an asset was retired, and then by subsequently obscuring that information with incredibly vague disclosures, the company failed compliance with both Ind AS 16 and Ind AS 1. This is a massive red flag for investors and auditors alike. It really just proves how one seemingly minor, throwaway wording choice in an accounting policy can completely unravel the integrity of your financial reporting.
So that brings us to Section 6, Elevate your compliance. Let's talk about how you can avoid these pitfalls with GAAP advisors.
How can you make sure your financial statements, or the ones you're auditing, don't end up as our next forensic case study? Well, I highly recommend leveraging the immense resources at GAAP Advisors. Head over to gapadvisors.com and register for free. Once you're in, you unlock this massive repository of over 4,500 issues and their detailed responses on Indian accounting standards and Indian GAAP. You can even submit your own issues for free and get a detailed response delivered straight to your inbox. It is an absolute game changer, particularly for auditors who need solid documentation on how they addressed complex Ind AS applications. Also, you can actually get your financial statements reviewed by GAAP Advisors before signing them. Just submit your near-to-publishing PDFs to info@gapadvisors.com. To keep your skills super sharp, make sure you subscribe to the free Task Weekly newsletter on LinkedIn. There are over 230 editions available right now. And if you want a really deep dive into the specific observation we just dealt with, definitely check out the GAAP Advisors Ind AS Clinic podcast on Spotify, Amazon, or right here on YouTube.
So, I'm going to leave you with this final thought. Are your financial statements obscuring the truth without you even realizing it? Thank you so much for hanging out and giving me your time today. If you found this explainer valuable, please go ahead and hit that like button, drop a comment with your thoughts below, and definitely subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And most importantly, please share this explainer with your contacts, your colleagues, your audit and finance teams, and especially with students pursuing their CA course. It really helps spread this crucial knowledge of Indian accounting standards. Thanks again, and we'll see you in the next one.